Many people know Warren Buffett as one of, if not the greatest investor today, with a track record of gains surpassing all stock market indices. But very few know his story in detail. That's what we're going to see today in this documentary about the incredible journey of the ambitious young upstart who became an icon of Wall Street. For those who are interested and want to go further, I highly recommend one of my favorite books because it's told with so much humor and juicy details, Snowball, or L'effet boule de neige in French, which is his autobiography. Without further delay, I'll hand it over to Robin. Let's get started with the video.
An ambitious young businessman, Warren Buffett is only at the beginning of building his financial empire. He singled out a struggling company in the hope of dismantling it and selling its assets. Sunborn Maps provides insurance companies with minute-by-minute maps of power lines, water pipes, and urban traffic. Long before the advent of GPS, it was very difficult to create accurate real-time maps, but they are very valuable for insurance companies. They help insurance companies analyze risk factors in order to develop better insurance policies. But as the industry consolidates, Sunborn's customer base shrinks, causing the stock price to be well below its book value. For Buffett, this is an opportunity to make money with almost no risk. He discovers that a company owns a portfolio of assets that, if liquidated, would yield $65 per share. But there's a problem. To convince the company to liquidate this portfolio, he will have to get a seat on the board of directors. To do this, he will need more capital. And Buffett knows exactly where to raise funds. Because when Buffett thought this investment was a sure thing, he brought in his whole family, his aunt, his mother, his father. He tried to raise money from everyone he knew. Buffett's goal is to have enough money to get a seat on the company's board of directors. 6 months later, he was successfully elected as a member of Sunborn's board of directors. Buffett immediately calls a board meeting and presents his plan to the other members to liquidate this portfolio in order to realize its value. But to his great surprise, they reject Buffett's plan. Buffett discovers that none of the board members own enough shares. They were profiteers exploiting company resources for personal gain. Warren Buffett has no interest in backing down. He will intimidate the board members into submission. His mentor, Ben Graham, taught him not to concentrate too much money on a single investment. But Buffett goes against this advice and immediately buys more Sunborn shares, gaining enough control of the company. Buffett returns to the board meeting. He informs the board that if they don't follow his plan, he will fire them all. Fearing for their own interests, the board members give in, agreeing to split up the company, and the young investor from Omaha walks away with a 45% profit on his investment. He will dominate the investment sector for the next 60 years. He will leave a significant mark on finance. He is nicknamed the Oracle of Omaha. Warren Buffett was born into a wealthy family. His grandfather owns a successful grocery store. His father makes a comfortable living as a stockbroker. But when Buffett turns 2 years old, all that prosperity comes to an end as the country sinks into the Great Depression. It's hard for us to imagine the suffering, the fear, and the feeling of losing all control. The Great Depression caused many families to lose control over their lives. His father, Howard Buffett, lost his entire fortune in the crash and is fighting to get it back. But he quickly finds a way to turn the disaster into an opportunity. He realizes that since people lost their fortunes in speculative stocks, he will instead start selling safe stocks that will help his clients protect their capital. Howard Buffett quickly gains a reputation as a cautious stockbroker who can help his clients protect their wealth. His honest and principled way of doing business had a big impact on young Warren Buffett. The greatest gift I ever received was being born to the father I had. So he taught me in every possible way, but he never taught me by telling me things. He simply taught by example. He had unlimited confidence in me when I made mistakes, and that takes you far, very far. For Warren Buffett, his father is his hero. Warren idolizes Howard Buffett mainly because he was never able to get his mother's love. I think we were terrified of her. When I woke up in the morning, I listened to her voice. I could tell by her voice if the day was going to be terrible or not. Warren Buffett's mother has a family history of mental illness, and many of her relatives were admitted to asylums. My mother had terrible headaches, and you didn't want to be near her when she had headaches, and she would lash out even more. She never did it in public. Even when Warren was a young boy, Layla Buffett often verbally abused Warren and his sister. You have a parent who constantly makes disparaging remarks to you, who constantly criticizes you, who constantly compares you to other children and shames you. And you know it's hard to hear. It's hard for a child, especially coming from their parents, who are supposed to be their protectors, their main caregivers. That will definitely interfere with your beliefs about the world and about yourself. The constant verbal abuse from his mother frightens young Warren and keeps him from socializing with others. He develops a habit of collecting stamps and bottle caps. As a little boy, Buffett really enjoyed sorting and counting objects. I think it's because it gave him a sense of order and predictability. But as Buffett enters his teenage years, his childhood problems lead him down a dark path. Howard Buffett is elected to Congress and relocates his family to Washington. The young Warren Buffett suddenly finds himself in an unfamiliar environment, unable to adapt to life in the nation's capital. While Howard is occupied with his duties as a congressman and his mother continues to terrorize him and his sister, the teenage Warren Buffett rebels. He started skipping classes and hanging out with the wrong crowd. He was stealing things like golf balls and was involved in scams. Warren Buffett's rebellious behavior continued until Howard Buffett decided to step in. He says to his son, "You can do better than that." Knowing that his father, the man who means the most to him, is disappointed, leaves Warren devastated. He promises to change and never let his father down again. During a trip to New York with his father, Warren Buffett is introduced to Sidney Weinberg, senior partner at Goldman Sachs. This meeting made a strong impression on the young Buffett. He saw in Weinberg the kind of person he wanted to become. The young man is determined to become rich, and he will do so by starting his own businesses. He earned good money delivering newspapers and owned a pinball machine. He managed to convince the local barbershop to install his machine there. Buffett excels at calculating probabilities. He realizes that he can take advantage of this skill by getting into horse race betting. When Buffett finishes high school, he has earned $5,000 from his various businesses, which is equivalent to $50,000 today. Although he initially planned not to go to college, Buffett is persuaded by his father to pursue higher education. Since he graduated at the top of his class, Buffett is admitted to the Wharton School of Business. While most students attend Wharton to become future corporate executives, Warren Buffett has only one goal: to become a better investor. He is thrilled to discover a co-author of his favorite book teaches at Wharton. The book is called Security Analysis, and the author is David Dodd. I got very good grades in college. I mean, my grades improved as I went through school, but I didn't feel like I learned much. But his attitude changes when David Dodd introduces him to his co-author, a man who will change his life forever. Benjamin Graham, a professor at Columbia, is the pioneer of an investment technique known as value investing. After witnessing the disasters caused by irrational speculation during the Roaring '20s, Graham thought about a better investment strategy, one that could generate profits without taking on too much risk. On Wall Street, everyone is so smart that their intelligence cancels each other out, and everything they know is already reflected in stock prices. Therefore, what happens in the future represents what they don't know. Buffett mirrors Graham long before they ever meet, and Graham immediately sees the potential of Warren Buffett. Half a dozen of them have considerable influence, and Ben Graham certainly influenced me a lot by giving me the investment framework I needed to move forward. Without Ben Graham, I simply wouldn't be where I am today. After graduating, Buffett enrolled in the MBA program at Columbia University and began working for the investment company owned by Graham. Buffett was hired as a stock analyst. His job was to research companies called cigar butts. The cigar butt investment approach involves trying to find a pathetic company, but it's selling so cheaply that you think there's just one good free puff left. We used to pick up a lot of soggy cigar butts, you know. While working at Graham Newman, Buffett gained investment skills, but most importantly, his job allowed him to look for investment ideas to grow his own money, which at that time amounted to $19,000, or about $200,000 today. He soon finds the perfect opportunity. Rockwood is a chocolate maker from Brooklyn, New York, but due to a sudden rise in the price of cocoa beans, the company is struggling to stay profitable. But Graham and Buffett discovered that the company has a large stock of cocoa beans that can be sold for a profit. But there's a problem. If the company sells the cocoa beans at market price, it will have to pay a heavy tax bill that will significantly reduce its profits. The opportunity is too good to miss. Still not knowing how to solve the tax problem, Ben Graham finds a partner who offers him an ingenious solution. Pritzker is an investor who knows tax laws well. At 32 years old, 7 years older than Buffett, Pritzker is looking to build his own business empire. To avoid paying taxes, he realizes that he could offer the cocoa beans to Rockwood's shareholders in exchange for their shares. Pritzker bought enough shares to acquire a majority stake and offered to exchange the cocoa beans with a $2 premium over the market value. Ben Graham immediately knows that this is a perfect arbitrage opportunity. He could buy Rockwood shares at $34 and immediately exchange them for cocoa beans worth $36. He would then use the futures contract to hedge against any fluctuation in the price of cocoa beans, which guarantees him a profit of about $2 per share with no risk at all. Ben Graham may have found a way to make quick money, but his student Warren Buffett is preparing something even bigger. Buffett realizes that if Pritzker is willing to overpay by $2 to buy more shares from Rockwood's shareholders, he must be convinced that this is an excellent company to own. Unlike Graham's strategy, Buffett puts 75% of his personal savings into the company's stock, betting everything on a rebound of the company's shares. If Pritzker is wrong, Buffett risks losing not only money, but also his company's reputation, especially with his mentor, Ben Graham. From the ruins of the Great Depression and the savagery of World War II, the American economy bounces back even stronger as the country enters the 1950s. Fortunes are being made everywhere, and the financial industry is reaping the rewards. Buffett is an ambitious young investor. He aims to be a millionaire before turning 30. While working for the legendary investor Ben Graham, Buffett thinks he has found the opportunity to make his first big move by investing most of his savings in a single stock. Buffett wagers it all on the chocolate maker. Rockwell stock goes from $36 to $85, and the young investor earns more than $13,000 in pure profit, which is equivalent to $144,000 today. Warren Buffett is a disciple of Ben Graham, but not an imitator. He understands the essence of value investing so well that he sometimes goes against the ideas of his mentor. Impressed by his protégé's performance, Graham quickly promoted him. Buffett is satisfied with his wealth and status, and he expects to quickly become a partner at Graham Newman's firm. But everything is about to change. Just as Buffett is ready to become a partner, Ben Graham decides to retire and dissolve his partnership. Ben Graham lost interest in investing because he thought he had enough for the rest of his life. In addition, he wanted to devote more time to other interests, such as women and fine arts. For Buffett, this event is a reminder of how much he hates not being in control of his career. With his degree, he could easily land a lucrative job on Wall Street, but Buffett decides to do the unthinkable at the age of 26. Buffett leaves New York and returns to his hometown, Omaha, to start his own business. Once I came back, some family members said, "What should we do with our money?" And I said, "I'm not going to go back to selling stocks, but if you want to partner with me, I'd be happy to do that." A few months after I came back, I set up the first partnership. With Graham's help, Buffett is introduced to many wealthy investors who entrust their money to his new investment partnerships. With enough funding for his new business, all he needs now is to find a big idea. Buffett achieved above-average investment returns. He needs an edge, an advantage that other investors don't have at that time. Buffett loved the pink sheets, which list the companies traded outside the stock exchange, often at a very low price. To be honest, many of these companies are scams. But Warren Buffett thinks there may be golden needles in this haystack. After a diligent search, one company catches his attention. National American is an insurance company located in Nebraska. Like many insurance companies, it started out as a fraud. But after years of legal maneuvering and changes in management, it turned into a legitimate business. Many shareholders are farmers who are unaware of the changes in the company and believe that their shares are still worthless. But Buffett thinks the company's shares are worth at least $100. The challenge is locating these farmers. Warren Buffett and his team personally visit these farmers and buy their shares, sometimes at a 70% discount compared to the original value. Many of these farmers are just glad their shares are finally worth something. By going where his peers are not willing to go, Buffett bets on National American, which brings him handsome profits, and he applies the same bargain hunting approach to many other more obscure companies, generating an annual return of 100% during the first 5 years. In 1962, Buffett Partnership has $7.2 million in assets, which is more than Graham Newman ever managed to achieve. At 32 years old, Warren Buffett is on his way to becoming a titan of finance. But what he doesn't know is that his next investment will be the greatest challenge of his career. Dempster Mill Manufacturing is a family business that makes windmills and irrigation systems in Nebraska, in a small town with fewer than 10,000 inhabitants. Buffett discovers that a company has an abundance of physical assets. Even though the company's performance is poor, the stock is trading at $18 per share for a book value of $72. That's almost unheard of now. So Buffett kept buying and waited for the stock price to go up. He could also liquidate the company to make a profit. Buffett buys enough shares to take control of the company, but he doesn't realize how incompetent the management team is. The managers at Dempster Mill didn't understand economic cycles. They kept buying more parts and making more windmills even though there was no demand in the market. This caused the company to accumulate a lot of short-term debt. With Dempster unable to repay its debts, the banks are ready to seize Dempster's inventory and shut down the company. For Buffett, this is the worst possible news. Buffett invested a fifth of his company's capital in this business. If the company goes bankrupt, he risks losing everything, and his dream of a financial empire will be destroyed. Eager to save his investment in the company, Buffett will need the help of someone with the resources and tenacity necessary to get things moving. He knows Charlie Munger is right for the job. Munger is a prominent California lawyer and an aspiring investor who dreams of financial success. He bought a windmill company in a small town in Nebraska, and Warren knew nothing about running a windmill company. He bought it because it was cheap. After assessing the situation, Munger realizes that the company is failing. To turn things around, Munger calls on one of his colleagues to replace the general manager of Dempster Mill. They laid off hundreds of workers, sold equipment, and closed 5 branches, not only to have enough money to pay their obligations to the bank, but also to survive as a company. After the bloodshed, the company is viable again. Buffett thinks he has solved the dilemma and might finally get out of trouble by selling the company to another buyer. But he has no idea what's about to happen. Buffett may have saved the company from bankruptcy, but in return, he has disrupted the lives of thousands of workers. Many people take to the streets to protest. The announcement of Buffett selling the company to another corporate raider sparks a wave of outrage. Many see Buffett as a ruthless liquidator focused only on getting rich quickly. Together, the residents launch a fundraising campaign and raise $3 million of their own money to buy back Dempster Mill from Warren Buffett. The company is once again in the hands of the local people. What Buffett did for Dempster Mill is now known as activist investing, but at the time it had another name, that of corporate raiding. What bothered Buffett a lot was that he never intended to make a profit, and people should be grateful to him for saving the company. Even in case of defeat, Warren Buffett makes a profit of $2 million from this investment for his investors. Warren Buffett seems to be a maverick, but Buffett needs to find a way to repair his reputation. His next investment will give him the opportunity to do so. The 1960s are a turbulent decade for the country. Millions of young Americans are pessimistic about the future. But a young aspiring investor is still just as optimistic. Warren Buffett made a name for himself by buying struggling companies, making them profitable, or ruthlessly liquidating their assets. But his latest investment in a company led him to rethink his approach. After facing protests because of his involvement in Dempster Mill, Buffett now has to prioritize his reputation and his profits. It's a difficult balance to find in the world of finance, but soon he sees an opportunity to prove that it's possible. American Express is on its way to becoming a financial conglomerate. While the main business is credit cards, American Express also has a more secretive division that brings in huge profits. It's a company that issues warehouse receipts. So, if you own a large quantity of goods like oil or cocoa beans, you can pay American Express to inspect your warehouse and issue receipts that you can then use as collateral to borrow more money from banks. But an American Express client realizes that this process could be easily rigged to his advantage. He owns a soybean oil business, but he fills a large part of the tanks with seawater and installs a device to trick the inspector into thinking that there is only soybean oil. His scheme allows him to fool the American Express inspectors into giving him more oil receipts, which he uses to borrow a large amount of money from the banks. He spends hundreds of millions in loans to play the market and suffers a huge loss until his scheme is discovered. Unable to get any money from him, the banks turn to American Express, trying to claim hundreds of millions of dollars in losses. The stock price is cut in half, investors get scared, and the future of the company is now at stake. While American Express is going through one of the worst crises in its history, Warren Buffett seized the opportunity to invest and polish his reputation. Buffett saw American Express as well-managed, believing the market overreacted to this minor setback. He buys shares worth $1 million, hoping that the company will recover in the future. However, the banks which lost money because of this scam are demanding that American Express pay. American Express could file a lawsuit and argue that it doesn't have to pay because it is just as much a victim as the banks. The company's president, Howard Clark, plans to pay $60 million to the banks as a settlement and compensation. However, many American Express shareholders believe that this solution is too expensive and that the company should fight in court. Warren Buffett is not required to take a position. However, he decides to support Howard Clark's plan to pay $60 million to the banks that lost money. He believes that paying the compensation represents a huge short-term cost for the company. American Express strengthens its brand in the long term as a trustworthy company that people can rely on. Buffett wins the argument and American Express stock rebounds, allowing Buffett to make a profit of $3 to $3.5 million. Buffett's partnership keeps expanding as he continually finds good companies to invest in. In 1965, his fund manages $37 million. Buffett's investment approach has allowed both his investors and himself to become wealthy. Buffett succeeded by investing against the crowd. He's not about to change his ways. His stubbornness is about to get him into new trouble because he's starting to take on another struggling company, Berkshire Hathaway. For Buffett, Berkshire Hathaway looks like another quick profit opportunity, a poorly managed business but full of valuable assets that can be liquidated for a profit. I bought my first shares of Berkshire in 1962, and it was a textile company in the North that was destined to eventually disappear. It was a statistically cheap stock in a terrible business. Berkshire Hathaway was closing factories, which freed up capital and allowed for share buybacks. So I bought shares thinking there would be another tender offer at some point and that we would sell the shares for a modest profit. Buffett bought enough shares to become the majority shareholder. The current head of the company, Sidney Stanton, sees Buffett's shares as a threat of a hostile takeover and invites Buffett to a meeting. During the meeting, Sidney offered to buy back Buffett's shares at a premium, and they agreed on a price. But it turns out that the meeting was just a setup meant to probe Buffett's intentions. Warren Buffett is furious. If he hadn't intended to take over the company before, now he would. His emotions take over as Buffett is about to start a war to take over a company that's worth practically nothing. Buffett keeps buying shares of Berkshire Hathaway, determined to own the company and get revenge on Sidney Stanton. Buffett wins the fight and Berkshire Hathaway is now under his control, but it quickly turns into a hollow victory. The company is failing. Buffett may have defeated his enemy, but in return, he now owns a declining textile company. But he is finally ready to learn his lesson and turn this failure into an opportunity for growth. He is determined to turn Berkshire Hathaway into an empire that no one ever imagined. But he also knows that he can't do it alone. While Buffett takes on struggling companies to make incredible profits, Charlie Munger is quietly building his own investment fund. But the two future titans of American finance realized that they shared the same goal and that it was time to join forces.